IFRS 9, Financial Instruments, a Comprehensive Introduction. Welcome to Lecture 1 of the IFRS 9 Crash Course. In this session, we'll set the foundation by understanding what IFRS 9 is, why it was introduced, and the instruments it covers. IAS 39, the previous standard, had several critical issues. It was overly complex, inconsistent, and delayed the recognition of credit losses. Under IAS 39, provisions were only booked once there was clear evidence of default. This backward-looking approach made banks vulnerable during the 2008 financial crisis, when losses were recognized too late. To address these weaknesses, IFRS 9 was introduced in 2018. It replaced IAS 39 with a more forward-looking framework that requires banks and financial institutions to recognize credit risk from day one. Now let's look at the scope. IFRS 9 applies to a wide range of financial instruments, including loans and advances, corporate and retail lending, mortgages, government and corporate bonds, trade receivables, as well as off-balance sheet exposures like loan commitments and guarantees. This broad scope means IFRS 9 affects virtually every financial institution. The key innovation is the expected credit loss model, also known as ECL. Unlike IAS 39's incurred loss model, which only reacted after default, IFRS 9 uses forward-looking information, including macroeconomic forecasts, to anticipate potential losses. This proactive approach has several benefits. First, it strengthens balance sheets by ensuring credit losses are recognized earlier. Second, it improves transparency for investors and regulators. And finally, it lays the foundation for the three-stage model of credit impairment, which we'll explore in later lectures. To summarize, IFRS 9 represents a paradigm shift from reactive to proactive credit risk management. It aligns financial reporting with modern risk practices and enhances the resilience of the global financial system. In the next lecture, we'll dive into the core components of expected credit loss, probability of default, loss given default, and exposure at default.